gonna do like partially review, partially practice, and partially, okay, some concepts. This is only 12 variances. You kind of have the 12 variances and 11 journal entries. So you notice I'm like a accountant, right? So I keep my numbers straight, okay? So it will help you. So you have to kind of, okay, when you start reviewing, right? So are you able to do all the 12 variances? Can you write down all the 11 journal entries? So that's important. All right, before we look at the calculation journal entry, I wanna put that into context. So we talk about the standard costing, right? So but you need to put the standard. So for any company, they probably will have more than one costing system, and different costing systems will serve different things. All right. So for instance, so since we are talking about cost, right? So then immediately you will know there has to be how do we address the issue for material consumption, labor consumption, and so on. So that's why we have material, labor, overhead. Now there are in general 3 different types of costing system. The actual costing system, you get all the actual number. You have to keep track of all the actual number, right? So this is for financial reporting, right? Financial reporting, we use the actual number. We don't use a lot of, well, sometimes adjusting entry you do, but then from costing perspective, we try to use the actual number, right? Because you have to put the actual consumption of the resource on the financial statement. Now, normal costing is what we have been doing before chapter 8, which is budgeting, right? So we keep track of the actual material labor, but then we estimate the overhead. So this is chapter 4, 5, 6, and 7. Okay, so that's where we use the normal costing. Okay. Now for standard costing, this is what we did here. We estimate everything. So everything is estimated at the beginning of the year, and then recalculate again when we start doing the variance, because you have to have an apple-to-apple comparison. And then we're gonna compare with the actual costing. So this is why immediately, even in chapter 9, right? In this chapter, the company has to keep 2 sets of costing system. All right, so to keep track of different number. So hopefully this will be useful, because that's basically how you think about, well, so what information do I need, and which system do I have to go to get that information? All right, now, okay, so 12 variances analysis, okay? So you have to know all the 12, know how to do the calculation. You can memorize the 12 formulas, but if you want to do that, there's really no point to take class. Okay, I have to make it meaningful, right? So the reason you come take a class, I show you some tricks, right? So that you don't have to memorize the 12 formulas. All right, so I'm gonna show you how to do that. And then, so this is basically, so in terms of understanding, so the variance, total variance will be the actual minus standard, right? Sometimes we call standard, sometimes we call that as applied. So that's the total cost, product cost, including material, labor, overhead. Now, so the first layer is, when I look at the total variance, I separate that into material, labor, overhead, okay? Now, the second layer is, when I look at the material, labor, overhead, I separate that into price and the quantity. Okay, so this is why material, we have price and quantity, right? Material price variance, material usage variance, right? So labor variance, we have labor rate variance and labor efficiency variance. And then overhead, we have variable overhead and fixed overhead. So in total, that's 8, okay? Now, then the third layer, if you go to the process industry, and then you can, because they mix different labors and different material all together, it's really difficult to figure out what percentage of the labor and material you use. So in that sense, we are gonna look at the mix variance and the yield variance. Okay, so you can do this so notice that this is all for the quantity, right? So only for quantity of the material and quantity of the labor. All right, so that's basically conceptually, you need to kind of understand what we are doing, how we are gonna do this, right? So this is not enough, and then we need to look at this, right? So the price quantity component and the quantity component. And then sometimes for some company, this is not enough, then you have to look in detail between mix and yield. Okay. All right, so if you pay attention to accounting and regulation, so variance start creeping into financial reporting as well. So this is from 2020. So this is basically says, well, so in the managerial decision discussion section, they have to provide the underlying reasons for the changes in price and volume. Price and volume, that's basically price and the quantity. So it says the mix, but that's not the mix variance. It's basically the price variance and the quantity variance. So they give an example. So they said, suppose the sales actually coming down, right? So total sales. So they are not talking from the cost side. They are talking about from the revenue side. So it's a price times quantity, right? So how much you can sell and how many units you sold. All right, so if this is coming down, okay, so it's declining, right? But it's possible the quantity actually decline, but then the price actually go up, right? So you want to see what part of that actually attribute to the price increase and then offset by the quantity coming down, okay? So that's essentially the variance analysis, okay? That brings back to my initial point, right? So when you learn variance analysis, don't just focusing on the cost. You can focus on, you can actually apply the same concept into all the other different areas, right? So whenever you try to figure out, am I doing good? Am I doing okay on the sales? Am I doing okay to managing the finance, right? So in terms of interest payment, am I doing okay in terms of managing the asset, right? So any kind of things, if they have multiple aspects, you can use variance analysis concept to do that, right? So you try to tease out, holding everything else stay the same, only change one thing and look at the difference, and then try to look at one aspect difference, variation at the time. So that's the idea of variance analysis. All right, let me show you for all the 12 variances. So my whole point is you do not need to memorize the formula. So let me show you 3 tricks. So the first trick will take care of 6 variances. So this is basically what we have, right? So actual cost, standard cost. Actual cost is actual price times actual quantity. Standard cost is standard price times standard quantity. Then you borrow standard price and the actual quantity, and then you get the middle term. The difference of the two, that will be the price variance. You can calculate MPV, LRV, and the variable overhead spending. The second term minus the third term, you get the difference in quantity. Okay, so that's basically so this apply to all the material, labor, and the variable overhead. Okay, so this is so this is how you can write things down. Now trick 2, this is all about fixed overhead. So the reason you have to write in this way will help you understand the concept. All right, so you have actual fixed overhead, you have budgeted, you have standard. Sometimes we also call this as applied, doesn't matter. Okay, so the name doesn't matter that much. All right, so the key thing is the budgeted overhead is always focused on some kind of projected number, right? So January 1st, how many units you think you are gonna produce and sell. So that's the normal unit. Then you will have an actual unit. So now the difference between the budgeted and the standard is all about the units. You have to make sure you have that information in your calculation. If it happen to be here you use the actual units, here you also use the actual units, then you are wrong. Okay, so why do I say that? Because a lot of the time people will use AH to calculate budgeting. You will use rate time AH, and this is completely wrong because AH is actually the actual hour based on the actual units, right? So you essentially, when you use AH, you already use the actual units in your calculation. So that's why it's wrong. Later on, I'm gonna show you an example. So AH is never used in the calculation for fixed overhead variance. Okay, you're gonna see that. Okay, so if you find yourself start using actual hour in your calculation, that's wrong. Okay? All right. And then the difference here, so the first two is spending, the last two is the volume. All right. So that's basically, this help you conceptually understand what's going on with the fixed overhead variance analysis. Now, trick 3 is about the mix and yield. Again, 3-line structure, okay? So notice, because we are doing quantity, so that's why the price is always standard price. Very clear, right? So then you have the actual quantity, right, which usually will be given in the problem. Then you compare actual versus the standard. So that will be your mix variance, okay? And then for the second and third, and then SQ is always something you have to compute, all right? So then, okay, you keep the standard mix unchanged, and you compare, okay, what's the impact from AQ to SQ, that will be your yield. Now, how do you calculate SQ? So this is, okay, what you can do. So you always have a baby model, all right? So baby model give you some kind of input, all right? And then give you output, all right? So that will be the, okay, the baby model will give you some, okay, you put something in, something coming out. And then you're gonna have your actual data. So actual data, you're gonna have actual input, okay? And then you get the actual output, okay? So now, how are you gonna get, okay, so SQ. So SQ is something you can calculate on this side, all right? So I'm gonna, okay, put it here. And standard yield is something you're gonna calculate on this side, okay, on the right side, all right? So now let me show you how you calculate SQ. So SQ will just be, since I'm gonna calculate something on this side, all right, because that's related to the input, then I'm gonna start with the actual output divided by the baby output, and then multiply by the baby input, okay? So that's how you do this. So actual output divided by, I'm gonna say, okay, it's budgeted, but I can use B as a baby output, that's a baby model output, and multiply by the baby model input. All right. So just try to, suppose you wanna do standard yield, you wanna apply the formula to calculate the yield, right? So one of the things which is always hard is to calculate the standard yield. So standard yield, okay, because you're gonna calculate it that way, so you're gonna start with the actual input here, okay? So it's the same thing. If you wanna start, okay, SQ, I'm gonna start, okay, the actual, my starting point is going from actual output, go up to the output, and then go into the input. And then if I wanna calculate standard yield, I'm gonna start with the actual input, go into the baby input, and then, okay, baby output. Okay, so then that will be actual input divided by the baby version input and multiply baby version output. So that is your standard yield. So it's all about, you have to write down your baby model and the actual model. Okay, so if you can get that correct, so that will, okay, make sure your thinking is, okay, completely clear. Well, okay? All right, so I'm gonna, okay, so that's, again, so strongly recommend, okay, starting from now, okay, just once I post a copy of the homework, and then try to, okay, use those tricks, because the more you use those tricks, they will help you understand the concepts, but also help you, okay, become less dependent on the formula. Okay, so because ultimately I don't think, okay, so everybody can grab the formula and start calculating, then that's not, okay, that's no skill, right? So the skill is, well, so, okay, you're now using the formula and then try to do the calculation. So that's basically okay what I wanna show you. So trick 1, 2, 3. Okay, have that on your side, and then learn how to apply them. So that will be the more you do that, and it will become easier, especially with all the formulas. All right. Journal entry. We have 11 journal entry. So we have 2 for material, 1 for labor, 4 for variable overhead, 4 for fixed overhead, right? So that's 2, 1, 4, and 4. Okay. So when you review this, right? So it's easy to say, well, what's the journal entry? So just look at this slide and say, what's the journal entry to record the actual overhead, right? You have to think about what do we debit, what do we credit. If I want to record material requisition, what do I, okay, so there's no variance here, but if I, okay, try to record the material requisition, so that's, okay, use material, so I will debit working process and credit material, then I will have the quantity variance for material, right? So the MUV, right? So you kind of connect with, okay, which variance you have to use. You need to think about this, okay, just by staring at this slide and then try to think about how to journalize. So that will be a good way to exercise. Now, one of the things I have to remind you is, so sometimes if you are wondering, okay, so how come I'm doing my homework 100%, but when I do exam, okay, I'm not getting, I'm not doing really well. So the problem with homework is you always can check your work, right? So especially for the journal entry, right? So if you the account is wrong, so you check your work and go back and from the list and then pick another account and until it's correct, without thinking about what journal entry you are doing. All right, so my suggestion will be, okay, once you get a copy of the homework, and then try to do those journal entry on the piece of paper. Once you get it correct, then go back and plug in. Make sure you get it correct one time, at one take, not just going back and forth. Check my work, check my work. That just gives you illusion, okay, you actually grasp the material, right? So you do not wanna do that. You wanna, okay, make sure you get the answer correct at one take. All right, don't forget the closing entry, right? So we are gonna close all the variance accounts, okay? So that's important, okay? So, and then you can use, there's no way to memorize this. You just have to use the T-chart, right? So if it's already on the debit side, then if I want to close, I have to put on the credit side, which means I have to debit COGS, right? So you kind of have to go through that for every single one. So that will be the, T-chart will be your friend, okay? So you need to, try to utilize that. All right, so so this is the work, this is the example from last week, all right? So I have something I wanna show you. So I'm gonna, practice, trick 3, okay? So the trick 3, to write down the 3, and you see how easy this will be, okay? Let me remind you of the problem again. So this is a standard cost sheet. This is the actual number, all right? So we get the standard mix, right? So where do we get those standard mix? So that's essentially, you have 3A, 3 of A, 17 of L, they total add up to 20, right? So then the percentage will be 3 over 20 and 17 over 20. That's where you get the 15 and 85. Okay? So make sure you understand the information. And then we have the SP. So those will be the SP, all right? So standard price. So 3 times 4, that's 12. 17 times 6, that's 102. And these two add up to 114. So basically this small baby model, right? So you put 20 in, that includes 3 gallons of A and 17 gallons of L. So that's a total 20. You get 16 gallons out. The total cost for the company is 114, okay? So that's basically the small model. And then the actual model, you put in 6,000 and 14,000 L, then total 20,000, you get 16,600. Now, so to get, so this is the actual, all right? Now, you can directly use that already, but then this is AQ, okay? And then if you wanna get the actual mix, so that will be 6,000 divided by 20, all right? So that's how you get the 30%, all right? So then the other one is 70% because they have to add up to 100%, okay? All right, so the only thing, as I said, is SQ, right? So if I wanna set up the model, the only thing you have to calculate is SQ. So SQ is the only thing you have to calculate because I already have SQ, AQ, I have SP, I have the standard mix, I have the actual mix. So to calculate the SQ, then I'm gonna have the baby model. So 20 in, 16 out, all right? So then I have 20,000 in and 6,000 out, right? So I have those two models, and then I wanna calculate the SQ on this side, all right? So it's on this side, so that's why I'm coming, okay, so starting from this side. So 16,600 divided by 16 multiplied by 20, okay? So that's it, okay? So 16,600 divided by 16 times 20, all right? So that's 2750, okay? So that's SQ, all right? Now, okay, so all you have to do, I'm looking at this, right? So SP we know, AQ we know, standard mix we have, SQ we just calculate. You have everything. All right, so this is, okay, you already have the notes, so that's why I'm gonna, okay, show you. So you have the SP, right? So 46, and you have the AQ, so this is essentially, you can use AQ time the percentage. You can also directly use 6,000 and 14,000. They are exactly the same thing. But writing in this way, you can see clearly okay, what's the difference, right? Because the only difference between this number and this number is driven by the combination of 30, 70% versus the 15 and 85%, right? So that's why this is called mix, okay? So that's called mix, all right? So and then 15 and 85, you already see that. Now, okay, going from here to here, the only difference is AQ and SQ, all right? So then that's why it's called yield, all right? So that is okay, so you notice the only information you have to calculate if you use this structure is SQ. And then otherwise, if you adopt the formula, you have to calculate SPY, okay, so the standard price, okay, standard cost per yield, standard yield, right? So yield ratio, you're gonna calculate a lot of different things. All right, so now, okay, so this is okay what I wanna, okay, imagine, okay, in the real life, okay, so suppose we do not have those formulas, right? But as cost accountant, you learn how to do variance analysis. You know how to take if I have two things, okay, changing at the same time, I'm able to isolate one thing, hold that constant, and then look at the difference, the changes, the impact on the cost by changing another thing, all right? So now this is basically, when I look at from here to here, I have two things change. I have AQ versus SQ, but I also have actual mix versus the standard mix. So that's why I'm putting something in between. I'm holding the AQ, not change, but I'm only changing the actual mix and standard mix. And this is how, okay, so those two difference, I'm getting, okay, those two difference, I'm getting the difference between, because the mix, and then I'm getting the rest, okay, only because AQ and SQ. Now, okay, so one of the job the cost accountant have to do is, okay, you should be able to communicate with the manager, right? So the manager will say, look at this, okay, I got it. Okay, the difference here is because the mix is different, right? So I'm using different combination. It's supposed to be 15 and 85. Now I'm using 30 and 70. What about this? What does this mean, right? So how do I understand what's this? How do I communicate with people in the firm so that we can improve? So this is the part of the exercise, cost accounting, you have to kind of be aware you need to do. But I'm not gonna require you to do this, but I wanna show you this in class so you kind of get an idea how to derive this formula. At the end of the day, this is the formula we gave to the manager. But then the formula actually derived from here, by looking at the 2 and 3, all right? So now if you look at 2 and 3, the difference, okay, if I use 2 minus 3, right? So I have 4 and 15%, 4 and 15%, I have 20 and 2750, right? So 20 minus 2750. And then same thing go here. So this is the first line I got. Everybody okay? So I get, okay, 4, 15%, 20,000 minus 2750. 6, 85%, 20 minus 2750. Are we okay? So this is purely from this minus that. Okay? Common factor, I get this. All right? So this one, okay, is if everybody okay with this one, the rest is easy. Okay, so are we okay with this? All right, so now we have a common factor. So 20 minus, okay, 2750. Notice I'm not, okay, calculating like, okay, do the subtraction. I'm gonna keep it because I'm deriving the formula, all right? So I'm keeping the 20, 2750, okay, out. Then what I have for the first term is 4 times 15%, 6 times 85%, all right? Are we okay at this point? All right, so now, okay, so moving here, this is SQ, right? So this is SQ. So how did we get SQ? So isn't that 16,600 divided by 16 times 20, correct? That's what we got SQ right here, correct? So that's okay, so then I'm gonna, okay, move the 16 to below 200. So this will be, okay, this will be exactly the same. So going from here to here, there's no change, right? So I'm just moving 16, instead of being under 16,600, and then it's under 20. So that's what we got here, okay? So that's this term, all right? Now, up here, how did I get, okay, 15 and 85%? Didn't I use 3 over 20 and 17 over 20, correct? So that's how 3 over 20, I get 15, 17 over 20, I get 85, all right? So then that's okay, so 15 is 3 over 20, and 85 is okay, so 17 over 20. So that's how I get the third line. So third line, I just basically describe how I got the standard mix, how I got the standard quantity, okay? All right, so now, okay, so the next thing is a little bit tricky. So what you need to do is, well, so how do I get the 20,000? Okay, I'm gonna have 20 over 16 and 16 over 20, all right? Now, if I multiply 20 over 16 and then multiply 16 over 20, because 20, 20 cancel out, 16, 16 cancel out, this is still 1, correct? But if I write in this way, guess what? I have a common factor, right? So I got a common factor, 20, 16, 20 over 16, right? So 20 over 16 coming out, and what's left off is 20,000 times 16 over 20. And here is 16,600. Okay, so that's this term. All right, so over here, so there's nothing changed. Now, the next step is I'm gonna move the 20 inside. Okay, so if I move 20 inside, 20 times, okay, 20 divided 20, this cancel out. 20 divided 20, this cancel out. And what's left of is 4 times 3, 16, 6 times, okay, 17. What is that? 4 times 3, 6 times 17. That's exactly the cost, the total cost of the baby model, okay? So then this is, okay, so this how you get, okay, so 114, okay, so 114 is basically 4 times 3, 6 times 17, all right? So then the bottom, so this is, okay, the result of, move the 20 inside. Then divided by 16. 16 is what? 16 is how much we actually produce out. So you spend 114 to produce 16 ounces of output. That's your definition of SPY. Okay, so this is SPY, standard price per yield. All right, so now, okay, what do we have this? All right, so that is standard yield. So this is standard yield, and this is actual yield. So now we have the standard price per yield times the difference between yield. And the reason I have to use standard minus actual, because this is output, is almost like a revenue. The higher the better, the positive the better. So I want to be consistent with, okay, if it's negative it's better, so that's why I put the actual in the second term, okay? All right, so that is okay, so, and then this part is how you calculate the standard yield. So notice we go back to our baby model. If I want to calculate standard yield, I'm calculating standard yield is on this side, right? So if I want to calculate the standard yield, so I'm gonna start, because it's on the yield side, so I'm gonna start with 20,000 and then divide it by the baby input, multiply by the baby output. So that's exactly the same formula, divided by 20 times 60, okay? All right, so that is, okay, how the formula is derived. And then now you can just, okay, bring this formula to the manager, and everybody think that this is magical, right? So because, wow, you get, okay, standard cost per yield, and then I'm looking at the difference, okay, in yield, right? So then that will be your yield variance. Okay, so I want to show you this, so you kind of see, like, okay, peep into the black box, right? So you get the idea how those formulas are derived. Okay, so none of the formula in cost accounting is actually magical. It's just based on some basic concepts. But you wanna, okay, have the idea. I wanna make sure it makes sense to people who are not doing accounting, and stuff like this will make sense. Okay. All right. Any question? Okay, so let's move on. Okay, so as I said, okay, I want to show you stuff, okay, in class, so then at least you should say this, okay, once in your life. Okay, so that will be, okay, my purpose. All right, so this portion is all the concepts. All right, so I'm gonna quickly go through how you interpret the variances. Okay, so and then you need to, okay, there are some, okay, interesting discussions in the slides. You need to read the textbook and read the slides. So that's important, okay? So read the PowerPoint, also read the textbook. So make sure you understand at least, well, so when people say, well, so why my labor rate variance is unfavorable, okay? So what could be the reason? So at least you can come up with, okay, 1 or 2 reasons without knowing anything about the company, okay? So you have to be able to do that. All right, so we talk a lot about how to use it, right? So it's just, okay, 4 different methods, 4 different steps. So you can read this, okay, on your own. Now, okay, so for material variance, all right, so important thing is, okay, you have to know when we actually calculate the variance. Okay, so for purchasing variance, we are gonna calculate at the point of purchase. All right, so because it's related to the price, right? So how much we pay for the material. And for the quantity, we actually calculate at the point of consumption. Okay. All right. So when we talk about unfavorable, okay, price variance, so this is almost, okay, so we are only looking at, okay, the actual price is higher than the standard price, right? And then you probably will say, well, so what about the quantity portion? So the quantity portion only help you to understand whether you should investigate or not. It has nothing to do with whether the variance is favorable or unfavorable. Does that make sense? All right, so you have to be clear when we talk about the, okay, interpret the variance. We say, okay, this variance is positive or negative, or it's unfavorable or favorable. It's all driven by the difference. All right, so for instance, okay, MPV, all right, so I have to think about it. Okay, it's the difference, okay, evaluate on the, okay, AQ, okay? So AQ is there only to help you identify the total magnitude of impact, right? So if the impact is small, you can ignore, you do not have to investigate. If the impact is large, you have to investigate, all right? But then in terms of whether this is a favorable or unfavorable, it's all driven by the difference between actual price and standard price. So that's why, okay, so I'm highlighting, okay, so when you say unfavorable, it's all driven because the actual price is too high. Then there are a bunch of reasons, okay, so you can, okay, read them. And then when there's, okay, unfavorable usage variance, it's all because of quantity is too high. The actual quantity is higher than the standard quantity. So one thing you have to be careful is you cannot isolate, only look at the price variance and the quantity variance, because sometimes the quantity variance can be driven by the price variance. So let me give you some scenarios. So this is basically one scenario. So constantly the manager noticed there's a favorable price variance, but there's an unfavorable quantity variance, right? So then they try to go after the producing manager, say, well, you have to improve your efficiency. But the producing manager was like, well, so I try as okay at my best, but still, okay, so there are a lot of waste, and there are a lot of rework and everything. And the reason is because the pricing manager decide to use some substitute. Okay, so they use some substitute to like use the lower quality of the material in order to get a cheaper price. But then they to make sure they always have the favorable price variance. But then that actually leads to, okay, so you have more errors or more spoiled units, you have to redo a lot of things, and then the quantity, okay, variance will go up. Okay, so that will be, okay, something, okay, so you have to pay attention. Now, for direct labor, okay, so we are talking about, okay, so actual rate higher than standard rate, or actual hour higher than standard hours. Okay, so again, you can, okay, so kind of read through the slides. So one of the things, well, so intuitively, so this is, okay, the kind of the slides I want to make it, okay, put in the context and so that you understand, okay, more intuitively. So for instance, okay, for the rate, right, so this is about the rate, all right? So if initially the person who does the job have a lower hourly rate, but if the person was sick, you have to replace that person with another worker with a higher payment, then your rate variance will become unfavorable. Okay, so that's one of the reasons. You kind of have to dig into what caused the difference. And then for all the variance analysis, okay, so this part is actually the fun part, right? Doing the calculation is easy, but then try to dig out and then figure out what kind of, what caused the, unfavorable variance. That's the fun part. All right, for variable overhead, okay, so I'm gonna write this, I'm gonna erase it. Okay, so in general, this is not as important in terms of providing information. Not very important. The reason, but regardless, you kind of have to get some basic idea, right? So the variable overhead go up. Why is that the case? Maybe indirect labor, maybe indirect material, the price go up, right? So you need to kind of have the basic understanding. So that part is important. Now, what's not important is for the efficiency. So this, in the classroom setting, is exactly the same as LEV, right? Because it's about the actual hour is higher than the standard hour, okay? So whatever we know about the LEV can also be explained in the variable efficiency. So in this sense, well, so this is not that interesting. It's also not that useful. But in real life, if you use, activity-based costing, you're gonna start getting into how the use of different cost driver, that will become extremely interesting. So that's why I'm gonna erase this, okay? So in classroom setting, this is not important, not interesting, but in the real life, and this is indeed, depends on the setting of the company. It can be very, very important. Now, what's more important is actually fixed overhead volume variance. So if you think about the overhead variance analysis, the most important piece of information we're gonna provide to the manager is actually on this capacity, volume, all right? So how do we calculate this? Using our trick. So this is really budgeted, right? So budgeted fixed overhead minus the applied or standard fixed overhead, right? So then this is based on the normal level of activity. This is based on the actual, so this is normal units, this is actual units, all right? So you, as I said, the trick actually help you understand the variances, okay? So now when we have variances positive, so this is unfavorable. What that means is actual units is actually less than the normal units. So what does that mean? So if normal units is 1,000, actual units is 900. So you on January 1st, you say you're gonna produce and sell 1,000 units. Now in reality, you only produce 900, right? There can be a lot of different reasons, but doesn't matter what reason you have. If you have the capacity to produce and sell 1,000 units, you ended up not achieving that goal, that's costly to the company. And the cost, so that's why you have a variance, unfavorable variance, and the cost is actually underutilization of the capacity, okay? So you could argue, okay, the market is not doing so well, even we can produce 1,000 units, we cannot sell 1,000 units. So that's again the same kind of argument. We are not, it's very costly to the company, okay? So that's why the company in the economic downturn, you are now seeing a great performance from the firm. Now, okay, so suppose we have, negative. So that basically means that this is a favorable, okay? What do we mean by favorable? So you have 1,000, but you ended up producing 1,200, right? So you probably say, well, so since this is a capacity, how can we even produce more than the capacity? So usually the company, when they define the capacity, they are not saying, okay, to the fullest, right? So they will say, well, so I'm not gonna hurting the morality of the employee. I'm not gonna, damage the machine. So if, this is how much we can produce. But if you wanna push a little bit, you can produce a little bit more. So that's basically that kind of scenario, right? So if you expect the next year the sales is gonna go up, all right, so you can produce a little bit more. And the benefit of producing more is because you can lower the cost per unit, because the total constant fixed cost divided by a larger unit of production, the cost per unit will be less, okay? So that's what we call economy of scale, okay? So when you have unfavorable, fixed overhead volume variance, that's basically costly to the firm due to underutilization of the capacity. If you have favorable, that's economy of scale. So the manager is doing a good thing for the manager, okay, for the company. All right, so here is a case, a scenario you can read on your own. So basically looking at the fixed overhead variance. Now this is particularly important for airline company. All right, so because they also worry a lot about the capacity, right? So how many flights you want to schedule, right? So how many, to what extent you're gonna fill the plan, but not overfill, right? So no, and then there were a lot of costs relate to how how the airline company actually schedule their how many flights from what destination at what time, and then what will be the rule or policy to let people be on the waiting list and then off the waiting list and so on. So if you have too much, and then it's costly. If you cannot feel if you have too little, that's also very costly for the firm. Okay, so this is why we want to, if capacity is an issue, we want to be there, right? So cost accountant, all we do is try to provide information, help the decision making whenever needed. So if there's a need to figure out the capacity issue, and we should be there. So then the fixed overhead is basically one piece of information you can provide. All right. Now, fixed overhead volume variance turns out to be so important. So I'm gonna show you different ways to do overhead variance, okay? So if you read the textbook or read the internet, you probably will see all different kind of way to do this, okay? So this is actually quite easy, all Alright, so I don't want you to get overwhelmed. Okay, there's a 2, there's a 3, there's a 4. Okay, so it's actually not that hard because we already did the most extensive one. We did the 4. Okay, I'm gonna only focus on 4, but I'm gonna show you how you can easily go to 3 and 2. Alright, so so this is what we did. Okay, so we have the variable overhead spending, efficiency, fixed overhead spending, and volume. Now, if you want to look at 3, all we have to do, so the formula actually look differently because you will, you can easily get overwhelmed with all different kind of formula. Okay, so that's why I don't like formula. Okay, but if you look at the 3, so essentially you adding the variable overhead spending and the fixed overhead spending, and then together call that as the spending variance, and then you separately consider the usage variance for variable overhead. So this is based on the cost driver, and this is based on the volume. Okay, so that's the 3 variance analysis. Say we do this in 1 minute. Okay, and then for the 2 variance analysis, you just adding all the 3 together. Okay, so then call that as a budget. Okay, so then the rest of that is volume. But regardless of what you do, notice we always have volume variance. Okay, volume variance and volume variance. Okay, so that's why volume variance is actually the most important piece of information coming out from the overhead variance analysis. Okay, so make sure you get that part. Question? Right? I think I'm done with all the material. So I wanna kind of use the rest of the time to do a few exercise, practice. To show you, so there are so many different ways you actually can do the calculation. And now of course, if you only use the formula, that basically bind you into, I only have to do the problem in one way. Alright, so so this is solving the unknown. So this is we get a bunch of information. So that's the standards. So the top are the standards, those are the variances, and then we need to figure out, so this is AH, so this is the actual direct labor cost, and this is the actual units, right? So the only way to calculate actual units is based on, this is important concept, based on standard hours. Because only the standard hour will use the actual units, not anything else. Okay, all right. So one thing, so 0.08, this is the unit quantity standard. Okay. So where do you see the quantity unit standard? So that's in the standard cost sheet. Okay, if you remember the standard cost sheet, so usually we have 0.05 at $1 hourly rate. So $1 per hour, right? Per hour, right? So this is direct labor hours. All right. So then you get 0.015. This 0.015 is the standard. Is the unit quantity standard. Okay. So that's that information. Okay. Instead of putting 0.015, you can put this in. So maybe I should use a better information, right? So you should put this in 0.08, all right? So then you get, 0.08 dollar. Are we okay? So that's basically the position where you should put on the standard cost sheet. Okay. All right. So this is not that important. I'm gonna, so just, put that on the side. All right, so, and 3, so this is says, the standard rate for variable overhead is 3 per direct labor hour, so that's SVOR, is 3. Okay. All right, so then we get a bunch of this, we have a variable overhead, and then we have labor. All right, so how are we gonna do this? So we're gonna use our trick, so the trick is, so we have the actual variable overhead. All right, so it's based on AVOR and AH, right? And then we have the standard variable overhead, that's SVOR SH, right? So then I remember I'm gonna use SVOR and AH for the middle. So that's my term, right? So that's how I remember the model. This is the model I'm gonna calculate. And then we have LEV, right? So this is the variable overhead efficiency, not LEV. All right, so later on we will use LEV. All right, so it's a 300F. That's a positive or negative number? Negative number. So now this is not a favorable or unfavorable matter. So I'm doing the calculation, I'm gonna use minus 300 there, negative here, okay? All right, so the difference here, all right, so then I have SVOR, so this is basically SVOR times AH minus SH. So you probably say, well, so I can use the formula to do this. You are absolutely right. Okay, here you can use the formula to do this. All right, so SVOR is 3, okay, AH minus SH, so that's minus 300, and then we get actual hour minus standard hour is negative 100. Okay, we okay? All right, now, looking at this sentence, the direct labor hour used were 20% less than expected. What does that say? So direct labor hour used, that sounds AH. Expected, that sounds SH. What does this say about SH and AH?
AH is 80% of.
Everybody okay? AH is 80% of standard hour. So if you are not okay, so if you try to figure out what is it, okay, it's AH, first of all, is less than SH, right? Because it's 20% less. And then if AH is 20% less, then I can write AH is SH minus 20% of SH, correct? So that's how you get 80%. All right, so that's important. Okay, if you miss this, then okay, the rest of the calculation will be wrong. All right, so then given this, all right, so then I have 80% of SH, right, and minus SH, and then that's minus 20% of SH, correct? Equals negative 100. Okay, so then divided by, okay, negative 20% on both sides, so then you get 100 over 20%, so that's how you get 500. Okay, so 500 hours. Now, given SH is 500, then I should be able to calculate AH is 80% of that. Okay, so that's 400. So this is the first answer. Okay? All right. Now, let's calculate. Okay, so now we have labor, right? So direct labor. I'm doing the same thing. So looking at the direct labor cost, so I have the actual direct labor, right? So I'm just gonna do, okay, so it's SRSH, which means SRAH, okay? All right, so then I also have the difference is LRV, LEV, correct? All right, so LRV is 90U, so that's a positive 90, all right? LEV is a 450F, so then that will be negative 450. So that's not so bad, right? So then we have, well, so I'm doing the same thing, all right? So from LEV, all right? So I get SR times AH minus SH, and that's negative 450, correct? But AH minus SH, I already get this. That's negative 100. We okay? So I'm just gonna directly plug in. So that's SR times negative 100 and equals negative 450. So SR is 4.5. So So once you get SR is 4.5, then I can calculate standard direct labor cost, which is SR times SH. So that is 4.5 times 500, so then we have 2,250. So that's not so bad, right? But then our job is to figure out the actual cost. So the actual direct labor minus the standard direct labor, that's the total variance, which is the sum of LEV and LRV. So that's the definition, okay? So then that will be 90 minus 450, then we get negative 360. We okay? So then, because I already know the actual standard cost, so I can calculate the actual cost, so then that will be the standard minus 360, okay? So that's 1890. Okay? So actual equals standard minus, right? So standard you move to the other side, the minus 338. So basically standard plus the total variance, right? So if you wanna, okay, so do it a little bit slower. So that's a standard. So this is the total variance, all right? So total variance, total direct labor variance. So plus the total direct labor variance. All right? So then that will be the 2250, and total variance is negative 360 plus a negative, which is basically minus 360, then you get 1890. All right. Question? So if you can't follow any of this, okay, make sure you raise your hand. I can explain. All right. Number 3, okay, so that's for, okay, so for actual units, as I said, well, so it all based on standard hour, right? So standard hour is the unit quantity 0.08 times the actual unit, right? So once you get your standard, then you multiply by the actual units, you get your standard hour. So your actual unit will just be 500 over 0.08, all right? So that's the answer. I don't remember, it's a 600, I have to calculate, 600, 250 or something, look like, all right, yeah, 600, 250. All right, so there are many ways to do this, right? So some of you will say, well, so I got the SR, and I use the SR times AH, perfectly fine. Then, okay, then you have to use the LRV to calculate the actual. That's perfectly fine, okay? So there are many ways to do the problem. All right, second, okay, practice. So this problem is basically, okay, make sure you understand the definition of, okay, so the baby model of the fixed, the overhead, and then the actual model. All right, so let me, okay, so go through this. We have the standard indicate, okay, we have 200 hours required for 100 units. What you are looking for will be those two information. One is the actual units, which is 90. The other is the 100 units. So this is not necessarily baby model. This is more of the budgeted model. All right. So then, okay. So let me put that in. Okay. So it's a budgeted model. All right. So I'm gonna put 100 units. All right. For the 100 units, the budgeted fixed overhead is 700. The budgeted variable overhead is 400. Okay, the budgeted hours, direct labor hours, is 200. All right. Now for the actual, so you have to organize the information in this way, at least in your mind. Otherwise, you will get all confused. Okay. So notice all this information is based on 100 units. If I want to produce 100 units, my fixed overhead is 700, variable overhead is 400. This is like, static budget. okay? Total hours I need will be 200. But in reality, we have 90 units, alright? So then this is actual fixed overhead. So that's a 780. Actual variable overhead is a 435. And the total hours, which is the actual hour, is 190, okay? Notice I'm not calling this as a standard hour, okay? I do call this as an actual hour. All right, so that's the information, what goes where, right? So if you say, well, so if you produce 90 units, what's the fixed overhead? And it's not 700, it's 780, okay? So that, those information explain the, okay, 90 units. And those information explain, okay, what you think about, okay, for the 100 units. All right, now, okay, the first question is, okay, let's compute the total overhead variance, right? So the actual variance is this, right? So the total fixed and plus the variable, okay? So if you add them up, so I'm gonna, okay, just directly add. So this is, okay, 11, 12, 12, 15, okay? So this is 12, 15. Now, if I add this, that's 1100. Is it okay to use 1250 minus 1100 to get the total overhead variance? Why not? Why that's not okay? Because it's very easy to think of. This is a should be okay something we do.
Different
Hours and units. So it's okay, so it's not okay, it's kind of okay, you are there. So it's not okay because we are not doing apple to apple comparison. This is the total cost for 90 units, this is the total cost for 100 units. You are not comparing apple to apple, that's the flexible budget of the concept, okay? So how do we do this? We have to translate into, based on this, we have to translate into, if we produce 90 units, what will be the budgeted or the applied or standard overhead? All right, so that's basically, okay, what we need to do, okay? So based on the budgeting information, all right? So I need to calculate overhead cost per unit. Okay, so then that will, okay, based on that, so then that will be, okay, so the total 1100 divided by 100, that's 11 per unit. Well, okay? So this is all based on the budgeted. I'm all basing on this number. I'm not using over there. And then I will calculate, okay, so the standard or applied, okay, overhead for 90 units. See, that's important, apple to apple, all right? So then that's 11 times 90 is 990. Okay, so that's important. And then in order to, okay, emphasize, this is indeed apple to apple, so I'm gonna write actual. So the actual overhead cost for 90 units, so that's 1250. Okay? So okay, so because that's 780 and plus 435. Okay? And now you can get, okay, so the total overhead variance, and that will be 1215 and minus 990. Okay? So then that's 225 and favorable. Alright. So that's okay, that's thing number one, okay? You do not, okay, compare those two numbers directly because whatever you got is for different units. Okay, so that's why you have to make sure, okay, you understand that. All right, so second part, let's do, okay, decomposition for variance. I'm gonna do, okay, so variable overhead first. Okay, so variable overhead, so we have actual, okay, and then we have SVOR times AH, and then we have SVOR times SH. All right, now, a couple of things. This is, okay, kind of difficult. So the actual, we already know that. That's 435. So this is given. I'm gonna put it here. Now, SVOR, so this has to be calculated. That's the standard cost per hour. So I have to calculate based on my budgeted model, right? So variable overhead 400, and then total hours for 200, right? So then all correspond to 100 units. I'm matching, right? So this is the cost for 100 units. This is the hour for 100 units. So that's why you can calculate SVOR as cost divided by hours based on the, okay, so you have to understand what that is, right? So then that will be 400 over 200, and that's 2, okay? Are we okay? So it's a cost, okay, per direct labor hour. So then, okay, actual is 190, so then we have 2 times 190, so that's 380. All right, now, SH, so this is okay, a little bit hard, okay? So this is what I want to, okay, suggest you do, okay? I don't know whether I can convince you, but this is, okay, easier. So the way to calculate the standard, so this is just a model, right? So the way to calculate for any overhead, doesn't matter if it's variable or fixed overhead, you want to use variable overhead or fixed overhead per unit, okay? Multiplied by the actual units. Because the last, okay, standard cost is always based on the actual units. Okay, you need to calculate, okay, cost per unit multiplied, then I directly use the actual units in my calculation. Now, how do I get variable overhead cost per unit? Again, I'm gonna use my budgeting model. So I have 400 variable overhead for 100 units, okay? So this is basically cost over units, all right? So then that's a 400 over 100, and we get 4. Are we okay? So then I'm gonna directly use 4 times 90, so then we get 360. All right? So some of you probably say, well, I can't go there because my brain doesn't allow me to go there. I wanna, okay, use this. Okay, so if you wanna use this, so SH, okay, then you have to use hours per unit, okay, and multiply by the units, actual units. Again, actual units will include it in the calculation. How do I calculate hours per unit? Then I have to go back again. All right, so everything is based on the budgeted number. I have the hours, I have the units. Then I should be able to calculate hours per unit. Okay, so then that will be, so this is my, okay, the unit quantity standard. So I have 200 over 100, then I get 2 hours per unit. Okay, so now I go back here. So then what you do is, okay, 2 times 90, okay, so that's 180, okay? So now I can go back here and say, well, so this can really written as 2 times 190, 80. But guess what? 2 times 180 is 2 times 90, okay? So that's exactly 360. What I want to show you here is, well, doesn't matter which way you do, you put in 90 in the calculation of the last line, which is important. Okay, so this is a super important there. Okay, all right. And then okay, so then the difference. Okay, you can get the difference. All right, so then the difference. So this is the fixed overhead spending. All right, and then which is 435 minus 380. So then I have to calculate that. So then that will be 55U. And then you get fixed overhead volume. All right, so then that will be 380 minus 360, that's 20, is also unfavorable. Okay. All right, so quickly, so fixed overhead. So we have actual, budgeted, and applied, okay? So actual is given, so that's a 780, all right? And then budgeted and applied, the budgeted is also given, that's a 700, okay? So notice this is based on 100 units, alright? So this is the difference is, okay, based on 100 units. Applied, let's do the same thing, okay? I'm gonna use a fixed overhead per unit, multiply by 90. Okay, so how do I get a fixed overhead per unit? Fixed overhead per unit, and I'm using the budgeted number here. Fixed overhead 700 and over 100, okay? So that's a 7. So 7 times 90, so then we get 630. All right. Oh, I'm doing this wrong, right? So this is a variable overhead. I'm already, okay, flying to fixed overhead, which is wrong. So this is, okay, efficiency. All right. And now we are, okay, so we get everything correct. So this is a spending, all right? So spending is 780 minus 700, that's 80, unfavorable. And the volume, okay, so it's 700 minus 630 is 70, unfavorable. All right, I wanna check, okay, so that's important. So the 4 variances add together. So the sum of 4 variances, all right? So then we get, over here we have 55, 20, both are positive. And over here is 80 and 70, that equals 225 unfavorable, check. All right, most important thing, look at the calculation. Did I use AH? Is AH here? No AH, all right? So that's the, okay, that's a common mistake. So there's no AH, okay? So that's important. So you need to, okay, figure that out. All right, I gave you that. Okay, so I'm gonna skip this, okay, because you already, okay, see me, okay, doing one question. So just for the time being, I'm gonna show you the answer, okay? So the answer, on the notes, okay, last class I actually did this. So on the notes, you will see I'm giving you the 3 lines. In the answer, I'm giving you the formula. So you can do either way, okay? So although I suggest you do the 3-line structure, but you're welcome to do the formula. All right, so that's all for today. So here's the summary. So we will start a new chapter next class.